50 bips of a relief coming in. Hopefully, RBI intervention did play out, but let's see what happens today. But Sandip Sabharwal in the studios. Sandip, hi, good morning. You've been a macro watcher as well. What's the anticipation from RBI, given that growth and inflation, like we were discussing earlier, is not a concern right now?
Yes, so whenever inflation is not a concern, the monetary policy committee should ideally cut rates. Now, there is a lot of fear around rupee depreciation for some reason, although it's unfounded, but then there is fear, and to that extent, they might use that as a reason not to cut. So, I think I would say it's a 50-50 bet, because if I look into the thinking of the current RBI governor, I would think that he should cut. But let's see what the entire committee thinks. So, I would say 50-50. But the point is that if they don't cut, so it could be taken somewhat negatively by the markets.
Sandip, why do you think the depreciation rupee is unfounded?
The fear.
The fear, actually.
See, what happens is that we have a huge trade deficit, like last month was $40 billion, contributed to part by the US tariffs. Otherwise, on a run rate basis, we are at a $20-25 billion trade deficit. So, that has to be sustained by capital flows, NRI deposits, etc. Now, capital flows, all of us know, have been negative. NRI deposits still continue to be decently strong. So, on an overall basis, we are a deficit country. So, for that, and that's unsustainable long term. So, and we don't have a reserve currency like the US that we can sustain anything. So, the rupee depreciation is a given. Now, it should follow ideally interest rate differential. So, it should be 2-3%, but because 2 years the rupee did not fall, like 23 and 24 rupee was totally stable. So, there is a catch up which is happening. So, my guess is that by the end of this year, whatever levels we come to by 31st December, from there I do not see too much of depreciation in 26.
Sandip, you think more critical would be what the Fed does this time?
So, I think the Fed, unlike the RBI or MPC, the Fed is a very sort of democratic institution, in the sense that they look at what the market is expecting and they typically tend to deliver that. So, right now the market expectation is like, I think as on yesterday there was a 90% probability that there is going to be a 25 basis point cut. So, I guess that cut is going to come. So that also creates a situation where it makes sense for the MPC also to cut rates, because then the interest rate differential remains the same. They cut 25, we cut 25, so the differential actually does not grow. So, I think the US Fed cut is given. If they do not cut, then I think the reaction in crypto markets, AI related stocks, etc., could be brutal.
Very interesting. Sandeep, a year back, you called out that the RBI was behind the curve. I wonder what the view is now. I mean, I know that you're penciling in a likely rate cut today, and if that weren't to come through, you'd be disappointed. But growth has surprised on the upside, inflation has surprised on the downside, and not just surprised, materially surprised on the upside and downside. Talk to us about what that means in terms of your view, and how many cuts can the RBI afford given the rupee, and the fact that if at all the RBI were reluctant, could a pause well be on the cards?
Yeah, so the pause is on the cards. So, I would say it's a 50-50 right now, but I think they should cut to support growth, because finally the real growth seems high, but that's also because of the deflator. The nominal growth is still in single digits. So, we ideally need a double digit growth for us to actually reach that developed economy status whenever in the next 15-20 years. Otherwise, it's not going to happen.
Sandeep, you made a very valid point there, but the question which someone could, a contrarian can ask is that we are at 8.2% growth in Q2. Q3 is also expected to be very good because of the consumption spillover that will come into Q3 there. What is a 25 basis point cut going to achieve in terms of incremental growth for us?
See, that debate is always on, but what happens is when we look at the economy as an aggregate, so for you or for me, it might not influence 25 basis point, might not matter. But for the economy as an aggregate, when we evaluate it, then as rates move down, it has a positive impact on growth. So I would think that whether it's 25, so it's incremental, right? So let's say hypothetically they decide to increase by 25 basis points, then would your view be the same, that it doesn't have any impact? If they increase by 25 basis points, the market will fall, I think Nifty will fall 500,000 points.
The bigger issue,
Yes.
the bigger issue which is there in front of the RBI today is neither inflation nor growth. It's the rupee which is there. So how the RBI, what do you expect from the RBI with respect to rupee actually?
So I don't think rupee should be a big factor in the MPC decision making considerations, especially at a time when our reserves are ample. So if we were sitting at maybe 200, 300 billion dollars of reserves, and at that time there was a situation where the RBI had to take this decision, then it would have been different. So our reserves are ample. There is a current account deficit, but that current account deficit is running at 1.1, 1.2%. So it's not that it's 2-3% that we have to be really concerned. So I would think that rupee should not be a big consideration, and that's what the CEA also mentioned. So as per their evaluation also, the rupee depreciation does not seem to be a concern right now.
Back here watching the market, and we have with us Sandip Sabharwal. Sandip, ITC Hotels is BAT is exiting the company there. Do you think this overhang is over and now valuation is something which the investors will be focusing on?
Yeah, so valuations of hotels are not really cheap, but I don't think they'll become cheap given that the growth outlook remains strong, especially for luxury hotels. So this will definitely remove an overhang. So I would think that this is a decent steady return stock. So I think a 15% kind of CAGR stock over the next 2-3 years, it's a decent stock to own. I would think so.
Sadi, what will happen to Indigo? Because this time it's not like a fog delay kind of issue. This is a structural problem they're dealing with.
So it's a structural problem related to the entire industry, but obviously, see, Indigo is Indian aviation, so we have to accept that.
Yeah, exactly.
So when they have the 63% market share, so without it, the aviation industry doesn't exist. So obviously, this impacts them in the short run. It creates correction, but whoever is bullish on air travel long term, I would look at it as a buying opportunity if it corrects, because the longer term there is no significant competition that's going to come in. They will continue to dominate the skies. They have a good international strategy, which they are going to expand. And international typically tends to be much more profitable. So I think it came suddenly, so no one was really expecting this side of thing to happen, and the crew issues are real for them. So it's not going to be resolved anytime soon unless the DGCA gives some relaxation. So stock could remain under pressure, I would think, for the next few weeks also. It's possible because this is happening in the peak holiday season, so they will miss out that demand also. So but if it corrects another maybe 5-10%, it could be more of a buying opportunity rather than people should be looking at it and saying that let's get out of the stock.
You know, there's a rupee depreciation impact also which is there on airlines, right? Like for Indigo, for every rupee that rupee depreciates, basically, there's 900 crore impact on EBITDA for them.
Yeah, but it's more a accounting entry because it's the lease rentals, the entire tenure of the lease rentals, they have to account for at the new rate. So it's not there, it's a cash outflow which is happening in that particular quarter, but because these lease durations are 15-20 years, so the entire thing gets repriced at 90 rupees, and then they write that off in a single quarter. So
the numbers are going to be bad in this quarter in any case for them in that sense.
Yeah, because of the rupee is fallen. So every rupee fall, I forget how much impacts. You said 900 crores. Right?
Yeah.
So on reported, but it's not a cash flow impact. So that will be there. But then that everyone knew. So that was nothing new. But the new thing is what's happening now with the disruptions, etc., which will impact financials this quarter and next quarter both. So next few weeks it could be weak, but like they are saying, they should stabilize by early Feb. So I think sometime before that, maybe around mid-Jan, the stock could present some buying opportunities.
Deep, any opinion here?
So I would think that many of these new age companies, people ascribe too high a valuation to them without them having an established track record. and on a reported earning last year of I think 45 or 46 rupees EPS they had last year, the stock still is at 110 on what they reported. Now, if there are discrepancies in the accounting which I don't know about, but which some people are saying, then we don't know about those things. So, the problem with the 100 PE stock is that even if it falls to 50, then also it is expensive. Yes. So I think that's the challenge which many of these analysts are not unfortunately following these days, because 150 PE is not justifiable under any condition.
You know, they've come out with a clarification as well this morning, Keynes Tech. They're saying that the accounting treatment with regard to intangibles, that has been a concern as part of the Kotak note. By the way, they caveat and they encourage analysts to deep dive into companies, but they're saying that it is also as part of their responsibility, they need to clarify their stance. So they are saying that the intangibles is largely recorded in line with Ind AS 103, which is business combinations, and for the contract which their subsidiary or their acquired company Excrement Co has signed, it's the customer contract which is of value and which is an intangible essentially to Keynes Tech, which is why they've gone ahead and recognized it as an intangible. Excrement is obviously one of the companies that they had acquired, and a large part of that comes from the fact that they have a customer contract which is recognized as an intangible asset. So that is one of the explanations they've given. There are related party transactions, they say, which were eliminated in the consolidated financial statements as per Ind AS accounting. However, they were inadvertently not disclosed in standalone financial statements. This has since been rectified, they are saying, and has been noted for future compliance. This transaction was part of the overall financial statements in both entities. So they've recognized this as a concern area, and the fact that they've defaulted with regard to reporting disclosures on the standalone side of things, but they're saying that on the console side of things, disclosures are fine. This is with regard to purchases of 180 crores from Keynes Electronics Manufacturing in FY25, which are not reflected in Keynes Electronic Manufacturing's related party disclosures. Year-end payables of 320 crore. On this part, they say that related party transactions were eliminated again from console financial statements as per Ind AS. They are saying that, however, they were inadvertently again not disclosed in the standalone financial statements. So there are some disclosures, viewers, which were supposed to happen in console and standalone, have happened at the consolidated level, haven't happened at the standalone level, which is what is a problem. And the cumulative transactions on both of those is around 500 crore, which is chunky, mind you, for something like a Keynes Tech. The average borrowing cost for FY25 was a whopping around 18%, 17.7 to be precise. Now, to this, they are saying that the interest cost on average borrowings need to be considered given bill discounting. The interest cost will work out to be 10% including bill discounting, and they're saying that similar observations with regard to average borrowing cost would be around 25.3% for FY24. They've to justify that by saying that it's essentially 10% and not 17.7% as has been observed by the Kotak institutional analysts and the note that they have put out. So they've come out and they have rebutted each of those points. Stock obviously in very, very early minutes of pre-open sitting down 10%. Sandip, I know you may not have had the chance to reflect on each of these points in terms of what has been brought out in the note, but given the kind of comments or statements that have come out, do you get any comfort from it? Would you at all be tempted if another 5, 10, 15% correction were to come on a stock like Keynes to buy? Because you've got a very, very solid execution pipeline if that were to play out maybe over the next 3 to 4 years.
So from whatever you read out, I think it raises more questions than gives answers.
Absolutely.
So I think that's a problem. And the other part, what many of the investors don't understand is this entire bill discounting thing. So you artificially show lower receivables or debt on your books once you discount these things and realize the money by paying some commission and all. So I think all that also is questionable, because then the balance sheet looks leaner than what it actually is. So I think that's something which could become another question mark if people didn't know about it. I haven't gone so closely into the accounting. So if this is a new thing which has come out, then it is something which could be concerning.
But Sandeep, in this market, where are you getting that comfort on valuation to buy into? And is it only IT?
No, I think trend wise, I would think that next year should be good for financials overall. So I think the larger banks will still do well, many NBFCs do well. There is momentum in auto stocks. L&T, given what they have done on order booking, reducing the leverage on their balance sheet, etc., it still looks good. Like, so on the large cap side, I think many companies look very solid. Even Bharti, a company like Bharti, looks solid in terms of what the cash flows they are generating. So I think overall market, if you look at the larger cap segment, I think that looks pretty solid. On the mid cap side, I think opportunities will keep on coming as the things start improving on the ground.
But on a net basis, you think that in the near ahead, it will actually be large caps which will outperform vis-a-vis mid and smalls?
Although with the mid and small underperformance, one would be tempted to say that mid cap should outperform. But my guess is that next year could be more a 12 to 15% kind of return across segments. And I don't see a mid and small cap outperformance at this stage playing out.
Sandip, you think that the market now punishes any company with a high valuation, even if there is a small accounting issue comes into frame? It's just an excuse to bring down the valuation of that company.
Yeah, because see, these valuations are unsustainable. So for people who lived through the dot-com boom, so when companies used to trade at 100 PE, at that time it used to be look so abnormal. Now people are recommending 100 PE stocks with projecting next 5-10 years growth as if it's a very great thing. So many companies don't even know what's going to happen next quarter. How do you know what's going to happen 5 years hence?
But what's keeping Eternal under pressure, I wonder, Sandeep? And you know, there is a lot of chatter about Amazon now getting into food delivery, Qcom, etc. Do you think it's these global players? Because, you know, domestically, the competition is at bay and, you know, Zomato's or Eternal still holds that lion's share. But do you think it's fear of these global giants now getting into the business?
It's continued losses in the
Also,
quick commerce business, so which is concerning investors. So Blinkit is a superb execution actually outfit. If you look at it, I think what they have done, the way they execute their delivery schedules, and what they have done is very good from the consumer standpoint. From an investor standpoint, it's a separate matter, because if losses remain prolonged, so I think investors are still giving them leeway. The stock's around 300, so they are giving them the benefit of doubt. But if the losses continue the same way for the next 2-3 quarters, then we could see the stock actually come under pressure.